Okay, welcome everyone. We'll start our second lesson on Unit 1, Financial Reporting. In this lesson, we'll cover LO2. My name is Anjum Satar. My email address anjum@ukversity.co.uk. If you have any question, please just drop me email. Before starting our today lesson, let's recap what we learned during our previous lesson, Lesson 1. So, anything you remember from Lesson 1, what we learned? Yes? We'll recap.
Yeah, so from lesson 1, I understood the why do we prepare accounts basically for stakeholders so they can read information and make decisions. Then the matching concepts that apply to the accounts, like going concern, accruals, and the concepts like verifiability, faithfulness, whichever that the information has to be totally accurate in order for us to understand, and statement of comprehensive income, profit and loss and comprehensive income, statement of financial position, statement of change in equity, cash flow statements, then a control account, appropriation account. Yes, sir. That so far sums up what we learned from what we did in the first interview.
Brilliant, well done. And how many types of financial statement we discussed, we learned?
4 financial statements.
Well done, great. So we discussed statement of comprehensive income, we discussed statement of financial position, we discussed statement of cash flow, we discussed statement of change in equity. So these are the 4 statements compulsory for limited company, but other companies can prepare at least 2 statements. Yes, those not compulsory on public domain, but they can prepare as well. So in lesson 1, we covered be able to prepare the financial statement for sole trader and partnership. We discussed what is by sole trader. We discussed about partnership, and I mentioned your Partnership Act. We have in 1819 UK, but in India Partnership Act I think so is a 1940. So we have a Partnership Act. If nothing is written, we can share equally. Otherwise, in the partnership, we should have an agreement, and partner can be between 2 to 20, but in certain businesses like insurance and banking can be up to 50. So that's we discuss in a bit. We mention, and we learn be prepared for financial statement incorporating relating adjustment for sole trader. I mentioned a few end of year adjustment. Then we discuss about prepare incorporate relevant adjustment. We mentioned few things. Evaluate, prepare financial statement we can evaluate. Then we discuss how these financial statements can be used for different decision making for stakeholders. Today we'll go through our LO2, be able to prepare company's financial statement. So only the difference there was a sole trader and partnership. Here we are looking more company's financial statement. For companies, it's compulsory to prepare these statements. Again, we look adjustments, and today lesson we'll discuss about cash flow statement as well, and we'll evaluate needs and identify the correct and omissions. If we have any omissions, any errors, types of errors, how we can explore and how we can adjust these errors. So
I have one thing in that LO2, there is no distinction information given.
Yes. So in LO2 is key, inductive content, we really focus on these are the key points. Prepare financial statements. So a lot of things they just copy as it is from the LO1.
Yeah,
So
okay.
it's not a big difference there. But the key point here is a limited company. Yes.
Yes, okay.
So that's the main thing. And do we know what is meant by limited company?
So a limited company uh is when they have uh, uh how do I explain it? Okay, so they have money, that is the owner's money into the account, but also they have li yeah, I'm not clear with this concept.
Yes, limited company have a limited liabilities. Yes.
Yeah,
So nothing can be claimed against personal assets. So everything will be limited. Yes. So you have a limited liability. Company can be two types. Do we know the two types of company? Private limited and public limited. Last lesson
yes,
we did
yes, I
discuss.
know that.
So public limited can issue shares to the public. They need minimum requirement of £50,000 in the UK,
Yeah,
but in the Company Act 1984 in India, or it may be updated. I don't know, but that's the is applicable there. And we have a Company Act 2006 in UK. And private limited, of course, you already mentioned last lesson as well. Private investor, yes,
yeah,
they don't need to be. Okay, that's what we discuss. We discuss all these evaluation of inventory, state line, diminishing, irrecoverable, accrual, prepayments, yeah.
yeah.
But we didn't discuss about error, suspense, and these things, which we'll go through in today's lesson. That's all these key concepts we'll cover in our lesson today. So please, if
Yeah,
any
okay.
questions, please ask me. So
Yeah,
we
one small question I have. So I went through a typical statement of financial position. Now I'm used to the ATHE method of preparing a statement of financial position. It is non-current assets, current assets, which is tallied, and uh, then it is equity and liabilities. So first I put the equity, non-current liabilities, and current liabilities. Is this method also with others as well?
yes, basically when we apply the IES one, International
Hmm.
Standard one, we need to follow the proper layout. So always non-current asset come first, current asset comes second. Then we
Yeah.
have current liability. You minus from current asset minus current liability is become your net current liability. Then you have a non-current liability. So minus from the non-current asset. So that become your net asset. Net asset figure always equal to equity. Yes. And then equity figures will be your equity mean
But
your
my doubt is the should the equity be noted first or should the liabilities be noted first?
So first always when we prepare the statement of financial position, I'll
Yeah.
go through the format with you now under IES one.
Yeah.
I will go in a minute, IES one format that will help you clear concept.
Yes. Okay.
Because other way around, we in India and in different our subcontinent, we used to be divided into two columns before. We used
Yeah.
to
Yeah.
prepare journal before, but every transaction we used to record in journal, but no things change. Now we have a book of prime entry because no more computerized accounts instead of manual accounts. So slightly and more standardized thing because it's company not only working in one country, companies has operation in many countries.
Yeah. Okay.
So we have three these assessment criteria will focus, prepare the
Yeah. Okay.
financial with relevant adjustment, cash flows, and we can evaluate by the correct. If we have errors, how we can rectify. So limited company, as we mentioned, with the limited liabilities. Limited
Yes,
company
okay.
may be owned by management, by different people. Limited company may be owned by shareholders. Yes,
Yeah.
shareholder appoint a director, and they may be large in number of shareholders, and shareholder receive the share of profit. Then they
Yes.
provide the information about financial position, financial performance outside the business. Limited company must publish their annual report in the Company Act. According to UK, these must comply with the regulations CA Company Act, yes, and the accounting
Yeah.
standards. So we need to comply with the accounting standards. Huh?
Yeah. Shareholders receive a share of profit. Is that the dividends paid to shareholders?
Yes, so dividend is a return on investment. That's we not call they will get the profit, we call they will get the dividend.
Ah, okay.
Okay, so this can be slightly can be twisted around in different part of the world, but profit and loss revenue come first, cost of sales comes
Yeah.
second, then we have a gross profit, we have other expenses are we called overhead, are we called indirect expenses, then we have a profit before tax or profit from operation before tax, then we have a tax, then we have a profit or loss for the period. So that's the format for the profit and loss. Then we
Yeah.
have a
Okay.
statement of financial position. Assets come first, always we do. This
Yeah.
format sometimes some company, because this is a sole trader and partnership. I'll go through further down companies as well. Huh? So if it's a sole trader,
Yeah.
you
Okay.
do just assets, then you do liability, then you do equities. Huh? So this is your debit side, equity, and the liabilities on the credit side. According to accounting equation, this should be equal. Huh?
Yeah. Okay.
Then we discuss what sort of the things can be part of financial statement. We discuss asset, resource control by entity, liability is a legal obligation by law we have to pay. Equity is of course the interest in asset. Any yes owner if they have investment that's called equity. Income which increase the economics benefit. Expenses will decrease the economics benefit. Contribution from owner is mean more investment or investment in or distribution to the owner, it decrease the equity if they withdraw anything. Yes. So
Yeah.
that's
Okay.
that's the key term which we normally use in the statements and we should aware of. Then we already learned assets equal to equity plus liability. We can recognize elements in the financial statement based on the recognition criteria. Is it asset? It will flow the future economic benefit, then we can treat asset. It will reduce, it is a legal obligation. If it's an obligation, then of course we can recognize as a liability. Then we have a different standard for the recognition purposes. Like if we have an inventory at lower cost or net realizable value. So always we record the inventory lower the cost or the saleable value. Whichever is the lower, we should record the inventory, not on the higher value, always on the lower.
Okay.
So
One thing. Uh, Equity is equal to contributions from owners plus income minus expenses minus distributions to owners. Distribution to owners is nothing.
okay, equity mean capital, opening capital plus profit for the year plus any investment
Okay.
during the year.
Yeah.
Then we do minus if the owner will draw something from the business.
I mean
Like
like
here, contribution from owner mean opening capital. Then we have an income mean profit for the year. Expenses mean the dividend if we will pay any dividend, yes, to the
yeah.
shareholder.
Okay.
Drawing anything you draw we call drawing. Huh? So it become
No.
net capital, and the net capital always equal to net asset.
Okay.
Okay. Next, we're looking the measurement of elements of financial statement. Financial statement normally we record on the historical cost.
Okay.
Then we have a current cost, the cost to bought today. If we are buying something, we record on the current cost. Realizable value mean the selling price. Present value mean the value of the future cash flow, which we can adjust the time value of money. Maybe you learn about the PV, it's called present value.
That is the net present value.
Yes, for the future cash flow. So we can make adjustment because sometimes the value of the money is dropped. Our company, because always account need to be two things. Account need to be true and fair. As the accounts, if the accounts are not true, not fair according to the current market value, it need to be adjusted.
Okay.
Okay. Then we have a measurement after recognition. We have a revaluation. We can revalue if the like land can be revalued because we bought a land in 1950 and now with the land value is quite high. Yes. So we need to be revalue according to the market value. Yes. Revaluation. So revaluation is can be we can create a revaluation reserve and that reserve we can adjust it whenever value will go up and down.
Okay.
Then can be revaluation can be losses as well. Maybe the asset value dropped. Like Windows 98 CD, if we have in stock, it's dropped. It's not the same value when the Windows 98 was launched. And we can use this revaluation model to adjust the value of the asset. Then
Now, where does revaluation surplus come to?
sorry,
There's a term called revaluation surplus.
revaluation mean the value increase and decrease. Yes.
Yeah, surplus. So I'm confused with revaluation reserve and revaluation
According to
surplus.
the whatever the market or the fair value, whichever is a lower, not higher, inventories. IS2. Hello.
No,
Yes.
no. I come across one term called revaluation surplus. Is it debited or credit?
Revolution surplus is mean the gain, so that should be on the credit side. Yes. Because
Now it's okay.
because it's your income, sort of income. Yes.
Yeah,
But we
so
not
money is
create.
increased.
Yes, basically the value, the worth of the company increase.
Yeah, okay.
Okay. Then depreciation and deaccumulation. For depreciation, we know the we can depreciate, yes, on the fair value, and residual value is mean the value which we can dispose of asset end of the life of the asset. And always, we learn two depreciation methods, yes, straight line. So
Yeah, straight.
can be depreciation method, residual value, useful value. We can estimate how much is the depreciate, yes, our asset.
Okay.
Then we disposed of asset. When we disposed of asset, we looking always if we are selling more than the carrying value, we say is a gain. If we are selling less than the carrying value, we can say is a loss. Any question?
Yeah. My question was if mm, could you go back to the slide of that this, okay. So if an asset is sold, is it sold at its carrying value or at the value when it was acquisition?
Okay, because when asset we buy it, we record as the cost, yes.
Yeah.
Then every year we calculate the depreciation. Depreciation charge we transfer to the profit and loss. and then we call accumulated depreciation, then we'll put as a credit side as a reserve. When we disposed of the asset, we'll say asset at cost minus accumulated depreciation, will find the carrying value. Then if we are selling more than the carrying value, we have a gain. Yes, because that gain is our profit. And if we are selling less than the carrying value, then we have a loss, and that loss we'll put in the profit and loss as well.
So if the sale is a loss, then it will decrease money in the profit and loss.
Yes, you're right.
Okay. Now it's good.
Okay, then next we're looking the statement of cash flow, cash equivalent, and cash inflows. Cash can be inflows or outflows. And under the cash flow, we prepare under IAS 7, International Standard 7. Cash flow, we have three activities we call operating activities. Operating activity mean our normal operation, like if you're a construction company, construction is your main business, that's your operating activity, because your main money or main revenue is coming from the operating activity. Sometime you have a spare cash, you can invest, you can buy properties, you can sell it, that's your investing activities. Investing activity mean you're investing in the non-current asset.
This is with property, plant and equipment.
Yes. So if your non-current asset increase from the last year, this year, it means you have used more cash. If your non-current asset decrease from last year to this year, it means you have a more cash inflow instead of more cash outflow.
So if a non-current asset is sold more than its carrying value, then it's an increase in the cash flow.
Yes.
And if it's sold less than the carrying value, then it's a decrease in the cash flow. Is that correct?
When we sold off, not the carrying value, when you disposed of whatever the asset were, yes. So it means your cash, because cash coming in mean is not only you selling more than the carrying value. If you're selling more than the carrying value, you're getting more cash. Yeah.
Yeah. Correct.
Even if you're selling less than the carrying value, still you're getting the cash, because you're replacing non-current asset to the current asset. Yes, because you disposed of, you get the cash.
Sorry, I didn't get the last part which you said.
When you disposed of asset, because your non-current asset decrease, it means your current asset should increase because you're getting the cash. Yes.
It comes into a cash form, like bank or something.
If you have a property, you're selling the property. Even you're selling the property on the loss. Yes. But that property is giving you the cash. Yes. So your cash is increasing. Then next we have activity under cash flow is called financing activity. Financing, so we can increase our cash by increasing more shares, issuing more shares. We can increase our cash by borrowing more money from the bank, or if we reduce our non-current liability, then it means our cash is decreasing. Yes, because we use the cash to settle the liabilities.
No, if we borrow money to the business, won't it become a liability then?
No, but here we're just looking what effect will be on the cash. No doubt your liability will increase. Liability goes on the credit side, but your cash also increase. That goes on the debit side.
So basically, we just look at the cash difference between both.
Yes. So that's why it's so cash we reconcile operating, investing, and financing. We have two methods. Indirect method and direct method we use to calculate the cash flow.
Yes. Okay.
So then this is look like we start with the cash flow, first we always go through operating activity. Cash
Yes.
from our normal operation. We start profit before tax. We write at the
Yes.
top. Then we add adjustments. We finance cost. We add it back. Depreciation, finance cost mean interest cost.
Yes.
Depreciation is a non-cash expense. We add back.
Yes.
Dividend received. If we have a dividend received, we minus from, because dividend it's under investing activity, not under operating activity. That's why we minus from here. Gain on disposal. If we have a gain first place, we add it. Now we minus because this is investing activity, not operating activity. Then we look the last year, this year current asset, what happened in the inventory. If is the inventory increase, if the inventory decrease, it means cash increase. If the inventory increase, it means cash decrease. Vice
Yes.
versa. Uh, then is the trade receivables. We check last year, this year. If the trade receivable increase, it means cash decrease. If the trade receivable decrease, it means cash increase. Then we look the trade payable. What's happened last year, this year? If it's increase and decrease, it affects the cash. Then we'll say cash generated by operation. Then we paid interest paid. If we have, we minus tax paid. We minus. We'll get net cash from operating activity. It can be positive. It can be negative. This is indirect method, and this is direct method, where we can summarize everything instead of you put the separate each heading.
Yes. Okay.
Because there is no guidance. Whatever method you use, your answer will be the same. Okay,
Okay.
then we have a no, you have a net cash from operating. Then we'll go through investing. Property, plant, equipment. Last year, this year, if those increase, the cash will decrease. If we have a disposed of asset, your cash increase. If you have received interest, your cash increase. If you have a dividend received, your cash increase. Then we'll do positive and negative figures difference. We'll get the net cash from the investing activity. Then we'll do.
Doesn't net cash in financing activities come first?
Uh, it sometime we settle the liability, so it can be negative impact. Sometime it can be positive impact. Yes. If we issue
No,
more
because
shares,
I'm used to the method from ACCA saying IAS 7, the net cash used in financing activities is first, operating activities second, then investing activities third. Sorry.
doesn't matter, whichever order you put it, because that's the main thing. That's three activities. Some they do finance first, but normally finance come last.
Yes. Yes. Okay.
So then what you're doing now, you're looking all the net cash used in financing activities. So you're doing operating. Let's say operating is a positive cash flow, investing is a negative, financing is a negative. What your net cash flow is, a positive or negative can be. Then you're adding opening cash balance at the start of the year. When you do add these, it become your cash balance, whatever given in the statement of financial position end of the year. This year, your closing balance of the cash, this should be matched. It's called reconciliation of cash flow.
Yes. Okay.
Okay, then we have cash from operating, investing, all been explained here. Yes.
Yes.
Advantage and some limitations we need to look around how we can interpret. We can say this period cash increase, this period cash in decrease, why decrease. Yes, we can interpret and we can make the decisions.
Yes, I think a cash flow statement is done because you cannot just rely on a net profit. I mean, on a statement of financial position or comprehensive income. Because even if your net profit is good, you do not know where your cash is going. That's why we prepare a statement of cash flows. Is that correct?
Yes, because first you need to prepare the profit and loss, because the profit and loss every year we prepare from the scratch. Then cash flow is a link with the balance sheet as well. Yes.
Yeah.
We're looking to check cash movement in the balance sheet because the cash is part of balance sheet. Profit
Yeah. Okay.
increase and decrease the cash impact on the cash. Okay, next we looking, we already discussed about irrecoverable debt, yes, and the doubtful debts, yes. That's so that's we can, and this which goes in the profit and loss and balance sheet, yes. Adjustments. Then we discuss about accrual and prepayment in the previous lesson. That's our adjustment. So if
Yeah.
we
Okay.
have accrual expense increase, we do debit. Otherwise, we do credit. Yeah, debit and credit. Prepayment expense, we do credit in the profit and loss, but we'll do debit in the balance sheet. Then we have accrual and prepayment income. So accrued income we do credit in the profit and loss, but we do debit in the prepayment income we do debit in the profit and loss, we decrease income, and in the statement financial position we do credit because that is a liability still not we earn it. Yes.
Yeah. Okay.
So that's our debit and credit, and always we discuss, when you start year and you need to make adjustment, draw the timeline, yes, to
Yeah.
make adjustment. And the summary of debit and credit, accrual and prepayment, yes, we discuss income and expense, which side, which one is asset, which statement will go. Huh? So L is a liability, E is expense, yes.
Yes.
A is a asset, I is a income, yes. So all this being summarized in which side will go. Next I copied the link to do practice for you. Is a cash
Okay.
flow. So what you can do, you can copy this link because otherwise, in the one lesson really because you already know, because otherwise we can't really involve, maybe take few lessons to just clear the cash flow. Huh? You already know, so which is a good thing. Okay, so statement of cash flow, then you start your cash flow. Yes.
Yeah.
And this is a bit video. So we've been given, yes, how we can calculate. We have been given the pro forma, yes.
Okay.
So you adding the depreciation, yes.
And
Yes. So
oh,
so that
1 second. Why is profit on disposal subtracted?
profit before tax we've been given, yes. Then we have a depreciation is a non-cash expense.
Yeah.
Profit on disposal, first place we add it, but this is not a operating activity. This is an investing activity. So
Okay. No. Hello. Hello.
Hello.
Yes, hello.
Hi. Sorry, I think so is some problem with the internet. I don't know. Okay, so we look, this is 34. Yes, 34. The disposal. Yes.
Yeah,
In
okay.
the first place, we added in the profit loss, but that should go under the investing activity. Yes, asset come under investment. So that's why
Yes.
we mind there. So it's quite good, to watch and do. I copied the link for some cash flows as well. Okay. So which I'll go through. So next we're looking now errors, types of errors. Hello. Okay. Next we're looking the types of errors. So we have a different types of errors. Errors in the trial balance. So types of error of omission mean you miss something. Ordinary errors is mean you did some debit and credit. You did things wrong. So credit sales is posted as debit the sale ledger control. So sometime you have these types of errors and how we can make adjustments. Hello.
Hello.
Yes, welcome. So next we're looking the errors. Errors in the trial balance can be omission. It means you missed out totally. Original entry errors, we do debit equal to credit, but the amount is incorrect. If the amount is incorrect, that can be imbalance, yes. So
Yeah.
credit sale was 1000 is posted as debit the sale ledger control and credit the sale 150. It should be 1000. So reversal of errors, we do the debit the sale by 1000 and credit the sale ledger control by 1000, yes. And then
Okay.
we'll do the correct entry. Error of principal, it means expenses and asset both goes on the debit side, but if we'll charge to the wrong, like 500 spent on repairing of motor vehicle has been recorded as motor vehicle 500 at cost, but actually was expense and we are saying asset. Yes, that's the principally wrong. Sometimes
Yeah.
company use this approach to show more asset instead of more expense. So creative
Yeah.
accounting. So
Okay.
which we shouldn't, because we should do the true and fair information to our users. So next
Okay.
we looking the error of commission. It means the commission is debit equal credit entry made wrong account, but not the wrong type of account. Like, we should say the telephone expense, but actually we are saying insurance expense. Yes. So cash
Yeah.
is right, but we are is also can be, because principally or we can say we're supposed to receive Mr. A and we are saying we're supposed to receive trade receivable Mr. B. Yes, receivable
Yeah.
or
Correct.
receivable, but we are giving to the wrong person. And entry duplicate, one side is nothing and the other side, yeah. So we can debit sale ledger control and debit sales. We should do the credit sales, yes.
Yeah. Correct.
So account balance incorrect transferred to the trial balance sometimes can be incorrect. So that can create imbalance between the accounts. So then we copied some single entries. Yes, errors that can be caused the difference in the trial balance, because
Yeah.
one of our inductive contents we need to make adjustment. So if we have an entry, single entry, it should be a double entry. Yes,
Yes.
costing
Correct.
addition. If the ledger has not been balanced correctly due to the costing errors, then mean the trial balance will not balance. Transposition, if the amount of the ledgers or the balance of the ledger has been transposed and incorrectly recorded. Yes, we should record 5291, but we recorded 5219.
Okay, understood.
And then, of course, extractions errors. If the ledger account balance is incorrectly recorded on the trial balance, either by recording the wrong figure or putting the wrong balance on the wrong side. Yes.
Yeah, okay.
Omission one ledger can also be create imbalance. Two entries on the one side. Yes.
Yes,
You not
correct.
did the other side, so that can create an imbalance. Then
Yeah,
we discuss errors not deducted. Sometimes these are not deducted because your debit and credit right in the trial balance. Yes. But
yeah,
errors
correct.
you can't call asset even is expense. Yes. So we call error of original entries, error of compensating errors. By one side you're putting higher, you're putting other side higher as well. Yes. So you
Yes,
can't really trace it. Errors of omission, you miss something, you can't trace in the trial balance. Error of commission, you saying Mr. A instead of Mr. B, yes, you receive our
yeah,
payment. You can't really trace it. Error of principal, like we said, you're doing expense debit instead of asset debit. A reversal, you're reversing, you're saying sale ledger control account is credit, purchase ledger control is a debit, so you're making but you're doing wrong.
okay.
Okay, suspense account, which is known as a temporary accounts. Suspense account
Um,
more,
your computer is showing me the statement of cash flow things, not the slides.
sorry,
You have that link which you copied to show me the statement of cash flows. No, I'm only seeing I'm not seeing the slides.
can you see now?
Now I can see it.
Okay, suspense account is used two circumstances to hold the trial balance difference prior to its corrections. When the correcting the posting of the item is uncertain, the suspense account just use temporary holding account until correct account posted to the and decided. Only these are like you're doing debit and credit. Yes. So what you did,
Yeah,
you did the bank debit 500. Yes. But you
yeah,
missed totally now. You didn't this period credit side anything. Yes.
yeah,
So in the next period to make adjustment, we do credit suspense. Yes.
yeah.
So we do debit suspense because of course in the next period we need, yes, and we do credit for suppose that was sale ledger control.
Yeah,
So that's the way we can adjust it. But this account is a temporary, this will be finished.
yeah.
It goes in the balance sheet because one other temporary account will be given somewhere
Okay.
which will make adjustment. Okay, next we looking next, I copied the link for you to prepare the financial statement with adjustments. Okay. So what we need to do, we need to copy this link. Yes.
Yeah.
When you copy this link, it asks you secure access. You can say yes, yes, confirm, say
Hmm.
yes, accept. It's open box for you. There are many questions, but first we looking first question. So if you can't find the starting button, you can zoom in and click
Yeah.
the star. Now,
Okay.
and you can zoom out if you want to make a video. And then
Yeah.
you've been given, this is your statement profit and loss format here. This
Yeah.
is your cost of sale, distribution cost, admin, and all. Yes.
Yeah. Yeah.
Statement of any. You've been given the trial balance here, so you can open.
Yeah.
Been given the sale,
Okay.
so that sale figure you can write here. Yes.
Yes. Okay. And then you prepare a statement of profit and loss from this trial balance.
Yes. This trial, and be given the adjustment entries as well. Huh?
Okay.
Yes. End of year
And then
adjustment. So what you can do if you can't dig out or how are you making mistake, you can open file as well. Yes.
okay.
So open file and go, because we are doing look level 4 financial statements. Please. This one. So click answers and you
Yeah.
can download answers. Huh? There's a lesson recorded, so that will help you as well. Huh?
Yeah. Okay.
So when you open it, so this is your answer. Yeah. So
Yeah. Yeah. Okay.
when you do, yes, if you're not right, huh? So then we have one question is, yes, change in equity assessment. Then have one question should be, yes, this is just a balance sheet, yes,
Yeah. Okay.
and there are many questions, but you just need to focus really cash flow.
Okay. So before the next session, I just do all of this workings.
To try, it's not compulsory, but it's help you. Huh?
Okay.
I'll send you some stuff to do just further as well. Huh? So that's the one thing. Last lesson we also discussed about Tesco and this. Yes.
Yeah.
So there's a given cash flow and various other statements. Huh?
Yeah.
Plus I'm going to send you. I'll show you. I'm going to send you. You can okay, and you're doing level 5. So I'm going to send you this tutor copy and student copy. Yes.
Yeah. Okay.
So is all the questions here with the answers? Huh? This is the format. Yes. Like you
Yeah.
were
Okay.
asking earlier. So you've been given. This is the answers. Basically you go through the question adjustment. At the end of the year,
Okay.
all adjustment given. You can see separate cash flow chain as well. Yes.
Yes. Okay.
Is accounting concept, material mean significant. Going concern we discussed last lesson, yes, business as a normal, accrued is a matching, other prudence in reality, consistent, we need money measurement, we record historical, duality, dual effect. Huh?
Yeah. Okay.
So that's, all the things there, with adjustments as well. Huh? So keep up to here, any question?
No, I'm pretty much clear with everything.
Brilliant. So today lesson we address limited company's financial statement, and we discuss about income statement, balance sheet, cash flow statement. We discuss types of errors, error of commission, error of operations, error of, and we discuss about revised profit after adjustment, how we can and what effect will be. And I copied the link for you, uh, Co and Morrison's statement as well. And I'm going to send you handout which is with the adjustments. Huh? And we
Yeah.
discuss about limited company, private and public limited company. We discuss about companies. This is just another company act, and we discuss, the four types of statement is compulsory to prepare and submit to the company house. So that's all was today lesson. If you have any question, anyone, please drop me email. My email address anyam@ukversity.co.uk, and I'll get back to you. Hope so. All will speak to you next week, next lesson, and have a wonderful time. Thank you. Bye bye.
Yeah.